Welcome back to the channel, guys. In today's video, I'm going to do a review of the dividend growth ETF from Vanguard called VIG. So let's just get right into it. VIG is the Vanguard Dividend Appreciation Index Fund ETF, and year to date, they're actually up 2.78%, which is doing a lot better than most of the other dividend growth ETFs like DGROW, SCHD. And as you can see, they have a current price of $156. So let's go over to Seeking Alpha, look at their dividends. So they currently have a yield of 2.04%, which is a decent yield. That's all right. They have an annual payout of $3.16, and their 5-year growth rate for the past, 5 years is 9.52%. I was going to say their dividend growth rate for the past 9 years, but 9.52% is an amazing growth rate. It's close to 10%, and it's better than 7%. So I would say anything 7% and above is amazing. So it's got that going for it. That's a positive. Now let's look at their fact sheet. And so their investment approach right over here, they seek to track the performance of the S&P US Dividend Growers Index. It's passively managed, full replication approach. Fund remains fully invested. They have large cap equity. They emphasize stocks with a record of growing their dividends year over year, which that's always great to see an ETF that focuses on growing dividends year over year. And then they have low expenses to minimize net tracking error. And then they have 46 years of management experience. Then if I scroll down here, you can see their expense ratio right here, 0.06%, which is a very low expense ratio. So that's what you want to see. All right, now I'm going to go over to the next page. As you can see, VIG has 315 stocks, a market cap of almost 190 billion, and then a PE ratio 21.9x. And then if we scroll down, you can see their top 10 holdings. Microsoft at 4.81%, Apple at 4.55%, ExxonMobil 3.09%, United Health Group 3.05%, JP Morgan Chase & Co. at 2.94%, Johnson & Johnson at 2.67%, and then they have Visa, Broadcom, Procter & Gamble, and MasterCard in the 2% range. So these are all household names, really great companies, a solid top 10 from them. Then if we scroll down just to their sectors, you had industrials and technology in the 19% range, healthcare at 14%, financials at 13%, consumer discretionary at almost 11%. And then you have staples, basic materials, utilities, telecom, and energy. So this is a good sector distribution. I do like that technology is not at the top. So now let's move on to the back test. So if you invested $1 million at the start of this fund, you would have started the fund at the end of 2006, so right before the Great Recession. And then up until now, you'd have $4,069,565. Your best year would have been 29.62%, and your worst year would have been 26.69%. And then my favorite part, going to the dividends. As you can see, in 2007, they made $16,322, and then they went up over time. They did have a year where they dropped, but besides that, they've been growing their dividend for the past 9 years. And in 2022, you would have made $75,774 in passive income, which that's really good. It's not quite 100,000, but you can't knock that. That's a great dividend income, especially passive income. So guys, thank you for watching this video. I do think this fund would be great. Tune in a few days. I'm going to compare it to SCHD.